The Fed is about to make its final move of 2025. Markets are pricing in a 90% chance of a rate cut. And if you sold your struggling software stocks last month, you just missed a 13% pop in Salesforce. This week, markets delivered an early holiday gift. And whether you're feeling optimistic or anxious about what's coming, you need to understand what actually happened. Let's break it down. Welcome back. I'm David Berkowitz, Chief Investment Officer at Value Aligned Partners. Every week, I sit down and walk through what's moving markets, what it means for your wealth, and how our portfolio is positioned. Now, I'm not going to pretend I have a crystal ball. Nobody does. But what I can do is share what I've learned from decades of analyzing businesses and help you separate signal from noise. Think of me as your guide through the chaos, not a guru with all the answers. So let's get into it. Markets delivered an early holiday gift this week: resilience. Major indices pushed toward record highs. Cooling inflation and steady growth have cemented expectations for a Fed rate cut next week. But here's the real story most people are missing. This was a Goldilocks week. Not too hot, not too cold. U.S. equities drifted higher in calm trading, with markets now showing 90% conviction that the Fed will cut rates on December 10th. Volatility stayed subdued. The VIX fell below 16. Investors looked past mixed labor data and focused instead on what matters: corporate clarity. But here's what I want you to understand. The real story this week wasn't the Magnificent Seven. It was the broadening. Capital rotated into software, into energy, into select healthcare names. And that is a healthy sign of a functioning market. Let's look at sector leadership. Technology led the charge this week, up 2.4%. The rally in software, companies like Salesforce, and semiconductors offset weakness in hardware. Year to date, tech is now up over 26%. Energy came back strong, up 1.5%. Crude oil rebounded about 2% on geopolitical tension and rate cut hopes. And communications, buoyed by that massive Netflix-Warner Brothers merger news, also gained 1.5%. Now, what lagged? Defensive sectors. Utilities fell 4.5% as investors rotated out of safety trades. Healthcare dropped 2.8% on pharmaceutical pricing pressures. When money moves out of defensive sectors and into growth, that tells you something about market sentiment. Let's talk winners. The top gainers this week tell a story of cycle turns and AI momentum. MongoDB, up 23%. This database platform crushed earnings and raised guidance. What does that signal? Enterprise IT spending is recovering. After months of companies tightening their belts, they're starting to invest again. Microchip technology, up nearly 23%. Why? Industry data suggesting the cyclical inventory correction in chips is finally ending. And Saia, a trucking company, jumped 17.5% on competitor struggles and positive tonnage data, a sharp reversal from recent lows. The pattern here? Beaten down sectors showing signs of life. That's where opportunities emerge. Now let's talk about the economic picture, because this is what's driving everything. The narrative this week was stability. The Fed's preferred inflation gauge, PCE inflation, came in at 2.8% year over year, still above the 2% target, but no upside surprise. Markets got a green light. Initial jobless claims fell to 216,000, the lowest since 2022. The economy is not crashing. Businesses are holding on to workers. And here's the key number: 90% probability of a rate cut on December 10th. Futures markets have spoken. Lower yields, with the 10-year at 4.18%, are actively supporting valuations in growth sectors. Let's talk about the elephant in the room this week: the Netflix-Warner Bros. Merger. $82.7 billion in enterprise value, $72 billion in equity value. This is the biggest media deal we've seen in years, and it signals something important. Scale is the only defense against tech giants. But here's the catch: this deal will face intense antitrust scrutiny over the next 12 to 18 months. Netflix agreed to a $5.8 billion breakup fee. That tells you how complex regulatory approval will be. For investors, this is a reminder: media consolidation is accelerating. The streaming wars are entering a new phase. Now, let's zoom out globally, because geopolitics moved energy markets this week. Ukraine and Russia. Stalled peace talks in Moscow. Venezuela tensions escalating. These events added risk premium to energy markets, pushing West Texas Intermediate crude to $60.08 per barrel. Gold, meanwhile, stayed flat at around $4,198 per ounce. It's consolidating after a massive run-up. Think of it as a quiet hedge while equities take the spotlight. Let's get into our portfolio. The value-aligned portfolio had a strong week, led by AI and turnaround stories. NXP Semiconductors, up nearly 17%. The auto chip inventory glut is ending. There's renewed optimism about automotive and industrial rebounds. Plus, AI tailwinds from edge processors and robotics. Salesforce, up 13%. They beat earnings, $325 versus $286 expected. But here's what got the market excited. Agentforce, their AI platform, hit $540 million in annual recurring revenue. It's their fastest growing product ever. Combined AI revenue is now near $1.4 billion, up 114% year over year. Ulta Beauty, up nearly 12%, beat earnings, announced the Space NK acquisition. Comparable sales, up 6.3%. They raised full-year guidance to $12.3 billion. The consumer is spending. Now, not everything was roses. Let's talk about the names that pulled back. Medpace, down 7.5%. CEO insider sales sparked concerns. And there's a bigger question. FDA is shifting towards single pivotal trials, which could threaten the CRO revenue model long-term. Kinsale Capital, down 7.4%. Rising competition in the specialty insurance market. Valuation being reassessed at 18.5 times forward PE, which is above peers. Eli Lilly, down 6%. They slashed Zepbound prices to around $2.99 to undercut Novo Nordisk. The market worried about margins, even though GLP-1 demand is surging. Here's the key point. These drops reflect specific news, pricing decisions, insider sales, not broken business models. Diversification protected us, while concentration in high-conviction names captured the upside. So what's coming next week? 3 major catalysts. December 10th, the Fed meeting. A rate cut is expected. But the real story will be the dot plot, the Fed's forecast for 2026 rates. That's what will move markets. Watch Chair Powell's inflation commentary closely. Also, December 10th, CPI data drops the morning of the Fed decision. Any hot surprise here could complicate the Fed's message and trigger volatility. December 11th, Broadcom earnings. This is a key AI infrastructure player. Their guidance will validate or challenge the strength we saw in chips this week. Bull case, Fed cuts and signals inflation is on a sustainable path to 2%. That triggers a Santa Claus rally in small caps and laggards. Bear case, Fed cuts, but signals a pause for early 2026 due to sticky inflation. That could cause a sell-off in high-flying tech names priced for perfection. Let me leave you with 3 key takeaways. Number 1, the Fed is your friend. For now, markets are confident in a rate cut next week. That supports equity valuations. The question isn't whether they cut, it's what they signal for 2026. Number 2, corporate America is adapting. Companies like Salesforce and Ulta are proving they can pivot via AI or M&A to generate growth even in a mature economic cycle. Number 3, volatility is normal. The drops in Eli Lilly or Medpace are uncomfortable, but they're driven by news we can analyze, not broken business models. Patience pays in compounding. This week proved why we stay invested. If you'd sold struggling software last month, you would have missed Salesforce's 13% jump. Panicked about consumer slowdown? You would have missed Ulta's 11% rally. The market is broadening. It's no longer just an AI trade. It's becoming an earnings recovery trade. Capital is flowing into areas that were left for dead. That's a healthy signal for 2026. As we head into the Fed meeting, expect some noise. Don't try to trade the minute-by-minute headlines next Wednesday. Instead, focus on this. The underlying businesses in our portfolio are generating cash and positioning for next year. If you found this breakdown valuable, do me a favor, hit that like button. It helps more long-term investors find this channel. And if you're serious about building wealth the right way, compounding your retirement, finding companies that can double their share price every 3 to 5 years, working with a team that acts as your fiduciary, I'm opening a few spots for free strategy consultations. We'll map out exactly where you are, where you want to be, and create a personalized plan. Link is in the description and the pinned comment. Let compounding do the work. I'll see you next week.